Well, welcome back to Chapter 21, and we are in Part C. We're going to go through some specific examples now of retrospective, and then in Part D, prospective application. So, just to review what you already know about retrospective or retroactive application, it's used for voluntary changes in accounting policy, as we talked about, where practical. Required changes in accounting policy where no method is specified, and for the correction of an error. So what you have to do, basically there's 3 steps. Retroactive application of new method, including income tax effects with an accounting entry or retroactive correction of the error. Then, and this isn't what we're going to concentrate on so much, restatement of prior period financial statements for comparative purposes reflect the change or the error. And that's so users can more effectively predict performance. The other thing you need to do is disclose the description of the change in the error and its effect in prior period. If you look at page 11 of your notes, page 10, not 11, I've got an example. Now, it is from 16, but I liked the issue that it has. So, just looking at page 10, the sample notice restatement, and this is for Fortune Minerals Limited, trade on the Toronto Stock Exchange. And, hold on, I just got to get to that little page. Okay, so in preparation of the audited consolidated financial statement for the year ended December 31st, 2016, it was determined by management and agreed to by auditors that as a result of the anti-dilution provisions of the Class A and Class B warrants, so think back to Chapter 16, issued by the company in 2015, the previous accounting treatments of the warrants in the financial statements was incorrect. So this is an error, so it has to be retro. Upon further investigation, it was determined that the warrants should have been recorded as a liability, a derivative liability, instead of a component of equity. Remember how we talked about in previous chapters how important it is liability versus equity, and liability takes precedence. So this is something where they put it as equity, but it really should have been a liability. And it talks about how they calculate it and so on. So you can read that. What I want to show you now is here's their statements. Notice they're quarterly. So September, June, and March, and then, this is going backwards, back to December 21st, 2015. So what they've done is restate as previously reported as restated. Previously reported, restated. So quarter, they've gone back and shown the change. Now, notice when you make an error, you're supposed to go back. Well, if the error happened 50 years ago, well, you probably wouldn't find it now. But even 15 or 7 or something, you probably don't go all the way back. Now with these guys, you remember, they issued the warrants on August 12th, 2015. So they're okay doing that last quarter and then stopping. So that is how you would restate. Just so you have an idea of how to do that. So the management discussion and analysis was also amended and restated. And as with everything, you can find all Canadian companies at cedar.com. Okay, statement, they found the error, they go retro, so they would have done an entry to fix it, and then the important thing is they show restated amounts so people understand what. Okay, so back to page 5. And let's go through some of these examples, and hopefully we can make sense of them. So you can work through the examples in your text to see a comprehensive example of retrospective work, including disclosure. We're going to go through some specific exercises. I'm going to focus more on the correction. Okay. So on example 2, on page 5, I tell you it's retrospective application. Of course, they're not going to necessarily tell you that in a question, so be careful. So, Hayes Instrument Company, a small company that follows ASPE, began operations on January 1st, 2020, uses a periodic inventory system. Following net income amounts were calculated for PACE under 3 different inventory cost formulas. So, here's the years. Remember, this is net income they're calculating. And this is the year of the change, so that's where we're sitting. And here's weighted average, and here's LIFO. So let's see what they're doing on the next page, and then we'll come back to this. So on page 6, now in 2023, PACE changed from weighted average cost formula to FIFO. And as it was agreed that the FIFO method provided more relevant financial information, otherwise they shouldn't have done it. You can't just go flipping back and forth. So we want a necessary journal entry for the change that took place. And first we're going to ignore the effects of income tax, and then I'll show you what would happen if we put income tax in. So first of all, ask yourself, is this an error? Is it a change in accounting policy? Or is it a change in estimate? Well, it actually is a change in accounting policy weighted to FIFO, but are we going to treat it that way? Yeah. Has any underlying things changed? No. So no underlying has hinted at, just more relevant says, oh, okay, we can do this instead of flip-flopping. So this is going to be a change in accounting policy, and it's going to be retro. Okay? So let's go back and look at the numbers here and see what's happening. So we're switching from weighted average cost to FIFO. So let's calculate how much then in each of these cases would have been, because we're going back 3 years. Because they just started in 2020, so that's all we can go back. So if you add up these 3 numbers, you get 84,000. And if you add these up, you get 76,000. So notice the year of change, our books are currently open for that. So we need to adjust for that. We do need to adjust for the previous years. So between these years, by switching from weighted average cost to FIFO, net income would have gone by the difference, which is 8,000. Okay, does that make sense? So I'm just going to recap. We're switching from weighted average to FIFO. We're doing it in 2023, so this is still open. So we had to calculate how much the net income would have been if we would have been using weighted average or if we would have been using FIFO. We're switching from here to here, so it went up by 8,000. That's how much we're going to have to be adjusting. So back on page 6. Now remember, those books are closed. Those are previous years, so we can't adjust net income for 2023. We've got to adjust backwards. So net income increased by 8,000. So we adjust retained earnings. So if net income goes up, does retained earnings go up or down? Well, it goes up. So retained earnings is going to increase by 8,000. Now, we're going to put the difference into inventory. Because new, higher cost inventory is remaining. Now, if if it said, oh, this end of the year, and remember this is periodic, so that's going to mess things up. But if already adjusted cost of goods sold at year end, use cost of goods sold. Okay, so the key thing, retained earnings went up because in the past, if we would have used the FIFO, net income would have been higher. So we're going to put that in inventory, which will then get transferred out to cost of goods sold. Okay? So if we had 30% tax, we would debit inventory 8,000. That's no different. However, you have to know that the CRA allows either method for tax purposes. So when you switch, the tax method changes. Okay? You wouldn't get that switching from straight line to double declining because CRA uses CCA, right? This is different. Inventory is unique. It's not about the cash, right? Because usually it's about the cash, but we don't have that here. So you would actually have to adjust CIT payable. So you would actually credit retained earnings for 8,000 times 1 minus 0.3, the after-tax effect, 5,600. And you would credit CIT payable for what's left over, or 8,000 times 0.3, the tax part, which is 2,400. So you will see CIT payable pretty much changing. I'm trying to think. There could be other examples because the text covers a lot of them. But generally, it's going to be only with the inventory ones. Okay? Okay. So I'm going to leave that video here, and we'll start a new video for the next part just because I don't want it to cut me off in the middle. Okay, so we will work on part B in the next video.